Welcome back, guys. Let's get macro. In May of 2025, the corporate bond market flashed a warning that most retail investors completely missed. My stability engine, however, caught it in real time. What you're looking at is the Credit Spread Stability Audit, real data tracking two critical markets simultaneously, high yield corporate bonds in red, investment grade in gold. And on the right, their FSR predictability scores from January 2024 through May of 2026. What are credit spreads? Quick context if you're new to this. Credit spreads measure how much extra interest companies pay to borrow money above U.S. Treasury rates. Think of it as the market's fear gauge for corporate debt. Spreads widen when investors are scared. They demand more compensation for the risk of lending to companies. Spreads tighten when confidence returns. Right now, the high yield is at 2.9%, and investment grade is at 0.83%, but that's not where the story is. Look at what happened around May of 2025. High yield spreads exploded to 4.5%. Investment grade blew out to 1.2%. That's a significant simultaneous stress event across both the junk bond and investment grade markets. The FSR score tells the story even more clearly. High yield predictability crashed to 73.2%. Investment grade dropped to 78.6%. Both fell below the stable threshold at the same time. When both destabilize simultaneously, that's not a sector problem. That's a systematic signal. The entire corporate credit market was repricing risk at the same moment. This was the tariff shock and recession fear wave hitting fixed income in real time. Since then, both markets have compressed significantly and stabilized. High yield back to 2.9, IG down to 0.83. FSR scores recovered 92, 92.9 respectively. The credit market is telling you fear has subsided. Companies can borrow cheaply again. Risk appetite is back. That's historically a constructive backdrop for equities. Here's why this matters right now. Credit spreads lead equities. When high yield spreads blow out like they did in May of 2025, stocks follow. When they compress back down like they are now, that's the bond market, giving the stock market a green light. Watch these numbers. If high yield starts widening again, while FSR drops below 80, that's your early warning that something is breaking in the credit markets before it shows up in your stock portfolio. All of this runs on predictability-api.com using real data. Same scoring system we use across stocks, engineering, sports, pharma, any time series data. Same math, different market. If you trade macro, fixed income, or just want to understand what the bond market is saying about stocks right now, subscribe. There's a lot more of this coming. Thanks for watching. I'll catch you in the next one.